All right, maybe I can start because I'll start with the intro and people can keep joining in. So welcome everyone to a new webinar. Today we're focusing on auditing of crypto. So even if an external audit might not be mandatory yet for your company, it plays a crucial role in building trust, not only for your investors, but also for stakeholders at large. So our focus today for this webinar must not be confused with a security audit of your smart contracts, but rather an external audit of the financial statements of your company. Now, due to the lack of accounting standards for crypto assets, presenting your financials can involve some degree of subjectivity. And if those are material figures, the external auditors are required to independently vouch for their accuracy. So today I have the pleasure to welcome two external auditors who are regularly carrying out the external audit of Web3 companies. We have James Newman, partner at Harris&Trotter, and we have Aymeric Monnier, manager of digital assets at PricewaterhouseCoopers. Both of these companies have been specializing in digital assets and providing services around accounting, audit, assurance, tax, and others. So maybe before we dive into the agenda, why don't we start with an intro of the speakers today? So James, can I ask you to go first?
Sure, absolutely. Hi everyone, my name is James Newman. I'm a partner here at Harris&Trotter. We are based in London in the UK, and we are a firm that specialises in crypto and digital assets, offering a range of services, and with very much a focus in including external audit. Part of my role here, I look after some of our larger audits within the firm of both UK entities and non-UK entities in various jurisdictions. As a firm, we are 85 years old, so we are a traditional accounting firm. However, we have since grown our digital assets department to in excess of 20 people, and that is a dedicated team looking after just digital assets.
Thank you. And Aymeric?
Yes, thank you, Aymeric. Thank you for the invitation. It's a great pleasure to be here. So I'm Aymeric Monnier, manager at the Digital Asset Trust Services. Very important to precise the trust services. Because at PWC we have a wide range of services around the cryptos, including consulting services and the trust services, which include financial audits, internal control review, and regulatory review. It's been now 6 years now that we have developed this specialty, and we aim to help our clients on the different topics of crypto, such as the financial audit, the regulatory, and the internal control.
Perfect, thank you. Let me go back to the agenda. So what we have today for you on the agenda is first on accepting an audit engagement and the different preconditions. How do auditors assert the ownership of crypto? Self-custody against centralized custody, good practices for valuation, and lastly, completeness of on-chain and transactions. At the end, we'll have a Q&A, 5-10 minutes Q&A. So do prepare your questions, but also as we go along, just feel free to include them in the chat bar. Of course, I have to give a quick disclaimer that this content today is for general information purposes only and is not a substitute for consultation with professional accounting, tax, or legal advisors. Quickly about the Web3 CFO Club, I think it's worth sharing at each webinar what we're currently doing. So we're a community of finance and operation leaders in Web3. And the community has been created by Request Finance. And I would say we have mainly two objectives with this community: to share best practices for Web3 financial operations and to allow yourself to network with your peers in Web3. Moving on to very quickly a little bit about myself. So I'm responsible to grow this community and organize different initiatives like the webinar we're having today. Next month, we are also having a big side event during ETH CC in Paris. I've shared a link of the event in the chat bar. This is a member-only webinar. So I highly encourage you to, if you're attending ETH CC, to drop by. It would be great to meet up in person. Just lastly, before we get going, last year we did publish a guide entitled the Web3 CFO Guide, and this year we'll be publishing the second version. So if you would like to be a contributor, the title of this year's guide will be mainly focused on treasury management. So if you want to be a contributor, just feel free to reach out to me on Slack. So with that out of the way, I think we can get going with the first topic for today, which is on accepting an audit engagement and the different preconditions. So given the inherent complexities associated with having crypto on the balance sheet, there are certain preconditions for the auditor to assess before accepting an engagement. I want to ask you guys if you could tell us some of the key factors you guys usually assess before accepting engagements of clients. If James, if you could start.
Absolutely. So at Harris&Trotter, when we are coming across a potential new client, especially in the audit sector, we don't necessarily view that client as more risky or less risky just because there's crypto assets on the balance sheet. We look at it on an entity by entity basis to actually really understand what is going on with that business, what they're doing, and where the crypto element and digital assets fits into that entity. It's then what they are doing with those digital assets which can lead to complexities, not necessarily just having them. One thing that we always need to look at and understand is what they're doing, but also how good is that record keeping for those digital assets, how they're tracking them, what they're doing with them, and how well they actually understand what is going on with their digital assets. And this comes in two parts. One is from the entity side of things in terms of the founders, the people running the business, and then also on the flip side, and sometimes more importantly, the finance function that might be in-house. So it's really getting under the bonnet of that entity, understanding what's going on, understands who understands what's going on at that entity, and then coming up with the conclusions of what the risky areas are of that audit and how we can address them. And often it might not be often it's not necessarily the crypto side that makes it complicated. We often take a step back away from it, and where needed, before getting to that audit stage, assisting that entity with understanding the areas where they might need to improve their internal systems and processes to get to an audit readiness position, which is then where our audit team might step in. So it's offering that range of services to help people get to that final position of being able to go through a successful external financial statement audit.
Yep. We do have the quite the same approach on PWC side, but we are considering the crypto activities as more risky than the traditional ones, because of the market, and not only that the market is unregulated, sorry, but also because management of some companies don't have the understanding of all the risks regarding the cryptos. That's why we need to go further to understand the internal control in place in the entity to mitigate all the risk regarding, for example, the crypto custody or the crypto flows. As example, we need to understand if they have AML process, if they use a QIT tool or anything else. So it's important for us to get a deeper understanding of the entity and of the management regarding the QIC and the AML process of the company.
Now, you guys, James, you're based in the UK, and Aymeric, you're based in France, and different jurisdictions have different requirements for companies to get external audits. I used to be an external auditor, and I do recall that if you're a publicly traded company, you'd have to obviously get an external audit. If you're a private company with your turnover exceeding certain thresholds, turnover, assets, or your number of employees exceeding certain predefined numbers, you'll have to get an external audit. Are there any other criteria applicable for certain companies holding crypto? Maybe if they hold certain licenses to get an external audit in general, apart from, I would say, exchanges?
No, from France side, there's no other obligation. If they respect the threshold and they're under the number of employees of total assets and everything, they do not have the obligations to get a financial auditor, even if they're registered to the AMF, which is the entity, the regulatory entity.
So again, no in the UK. However, if entities are registered with the FCA, the Financial Conduct Authority, whether that be for AML requirements, but also as often a e-money provider, then audit requirements do come into place that aren't necessarily financial statement regulations, but often the two come hand in hand. So the answer is sometimes yes, but it depends on the regulation. The area where we see in the UK a lot of companies falling foul of audit requirements is where they are owned 100% with parents that are large companies. That also means by virtue the entity that may be in the UK is just a cost center or a management company that on its own might be a small company, not requiring an audit. Because of its parent, it does require an audit in the UK.
Now, in general, publicly traded companies, it's mandatory for them to have an external audit. But I was thinking for companies offering token to, who have fundraised through an ICO, for example, these companies are not really, it's not mandatory for them to have an external audit, but like in the future, or what's your opinion rather on such companies who have offered their token for sale to the public to actually have an external audit and publish their financials to the community who have invested like money in them, in their token?
Look, it's all about transparency. So if that's something that your token holders and your investors are insisting and requiring from you, then that's something that should be done. And you need to gain the respect and the trust of the people and the stakeholders of your company. And often, even if there aren't regulatory or legal requirements for anything, including a financial statement audit, that doesn't mean you shouldn't be doing it. So lots of companies do different things that satisfy the needs of their stakeholders, and a financial statement audit is one of those. And quite often we see companies who don't have a legal requirement actually saying, hang on, we need an audit, we need to have our books and records in a good shape and in order, and we need to be able to provide those financial statements as and when people require them. And very often that's the number one reason people wanting an audit. We have clients often, they don't need an audit, but as in terms of their priority orders, it's number one priority for them is to be able to provide that information and that transparency. At the end of the day, crypto is about transparency, and the financials come with that as well.
I totally agree with James. It's quite the same philosophy. But if I may add something, is that it's not mandatory in France, but you can register your ICO at the IMF to get this registration and to show to your investors that you really want to get transparency and to allow trust around your ICO.
Perfect. So we'll move on to the next topic, which is on asserting ownership of crypto. So maybe if we start with the self-custody, what are some of the key questions to consider for when you carry out your audit to ensure private key storage and safeguarding? Even if this will depend on the type of wallets being used, what are some of the key internal controls that clients need to have in place?
Should I take this?
Go on, if you want.
Sure. Yeah, no. So the internal controls are really important. They're really important for the company, predominantly for them internally. They are internal controls to ensure that their assets are kept safe and that their wallets are in fact remain their wallets. Where that then feeds into the financial statements is hugely important, because if people don't really have those private keys and have the right things in place in order to protect those private keys, those wallets are no longer going to be their wallets. So when we are performing financial statement audits, the key thing is that we need to assert over is to ensure that people have ownership of those wallets. How do we do that? We have developed technology in-house that allows us to verify the ownership of our clients' wallets to ensure that their private keys remain theirs, and at the same time ensure that we have sufficiently gained enough external evidence that people do own the wallets that they say they own. In terms of internal controls that people can put in place, there's a whole range. So when you're talking about self-custody wallets, you're talking for cold wallets, physical protection of those wallets, breaking up private keys into multiple shards, and also the implementation of multi-signature wallets, ensuring that you have enough people that both have access to that multi-sig wallet to protect yourself, and also at the same time to ensure that you've got transparency within your business. The one thing that we do also remind our clients of is when it comes to setting up those internal controls, you also need to think of disaster recovery and worst case scenario. You know, just having all of your eggs in one basket when it comes to private keys doesn't work. If something happens to an individual, to a founder, you need to ensure that those wallets are still accessible by that company, and it's ensuring that you've got sufficient processes in place to protect those wallets both from external issues but also internal issues that might happen within.
Yeah, if I may have something regarding the ownership, we also need to ensure that the company has the exclusive ownership of the private keys. I mean, when we are auditing a company, we need to get the information of the key management and the key generation. And regarding this key generation, it's really important to get a good documentation of the way how these private keys have been generated. And most of the time, we ask our client to make what it called a key ceremony, which is a formal process of generation of the keys, and it will depend on the tools that is used. And it's formalized that all the steps were properly made during this key generation, and that the key generation is made in a secure way, in a secure environment that will allow us to make sure that the company is the only one to get access to these keys. So that's for the key generation. And then, as James said, we need to understand and to get the documentation regarding the key management, how the management proceeds to transactions, how they store their seeds, and so on. And regarding the ownership of the assets, we also have a tool that allows us to ensure that the management still have the capacity to move the funds from the wallet. It's called the keeper validation. It's a very common way to ensure the property of the seeds. It's just a message that we will send to the wallet, and the management will have to sign this message from their wallets. So the signature will approve the use of the private keys of the wallet, and that the company is still able to move the funds of the wallet.
All right, very interesting. I didn't know that. And how about for centralized custody? So for companies still choosing to hold their crypto assets at centralized exchanges or other third-party custodians. So usually what I understand, the auditors would be asking for an SOC report of that entity. Could you first start by explaining what is a service organization control report and the different types of SOC reports out there, and what do you guys actually check and review in those reports to give you assurance over custody?
Mm-hmm. James or
Aymeric,
Yeah, sure.
You can go first. Yeah.
Okay, if you want.
Yeah, go on, Aymeric.
Yeah, SOC reports are standard reports made by external auditor and independent auditor that will allow to attest the level of the efficiency, effectiveness of the controls. And there are two types of SOC reports, the type 1 and type 2. And those different types of reports allow to get comfort on a specific date or on a specific period. And it covers all IT, not all, but some IT risks, and it covers some called pillars. There are 5 different pillars, such as the privacy of the data, the access of the data, and there are 3 other pillars that maybe James can add more information about.
I mean, I wouldn't, without going into too much detail, as actually, with 1 being the point in time, 2, over a period of time and how effective those controls are over that period of time. I think the key thing when looking at these service organization control reports is actually what are the controls that are in place, and really just digging into that report rather than just saying, okay, a service organization has got a report, we're going to rely on that, the services of that service provider and the integrity of that service provider. Because it's very easy to get led astray by someone just having a report and relying on it. Instead, it's digging into the detail there, seeing what are the controls that are in place, and most importantly, how those controls are relevant to your financial statement audit. So a lot of those controls might not be relevant. They're great that they're there and they're good for that service organization, but they don't necessarily hit your financial statements. There will be ones that are specifically important, and it's reviewing those and ensuring that they address the key risks in our audits and ensuring that those controls are sufficient for that, ensuring that they've been implemented correctly and in a way that we would expect our own client to have in place. So it's taking a step away from that report, making sure that we actually dig into the detail and ensure that it is in fact relevant. Where it's not relevant, we might be able to find other controls that are that support it. However, it's really liaising directly with that service organisation as well, and not being scared to speak to them directly, and understanding how their controls, how their processes impact our clients, and therefore by virtue our financial statements.
And so what happens if that your client is not able to furnish an SOC report because that exchange or custodian just doesn't have one? I mean, in general, all those popular exchanges, do all of those have is able to provide you with an SOC report? The likes of Binance.
Yeah, so some are and some aren't. Some are more willing to give you their SOC report than others as well. For us, often it's less important whether they have a report or not. And it's actually looking at how much we can rely on the information that is being presented from those, from centralized exchanges, etc. And often we're able to put the dots together ourselves and then link that back to the information that's coming out of that centralized exchange. If all of the dots add up and make sense, then that's a very good indication, the same way as any other data that we're looking at adds up and makes sense. It's very quick, it's very easy to see without necessarily having to rely on controls whether we think data sets are correct or not correct, and maybe they're incomplete, etc. SOC reports don't necessarily help you with that. So we actually try not to place too much reliance on the likes of SOC reports, because we know that although they're helpful, they also come with inherent risks of over-reliance on service organizations.
Yeah. So let's move on to good practices for valuation. In crypto, I mean, valuing crypto is inherently different for a few reasons. I just mentioned a few there, 2 reasons. So markets never close. So what cutoff time should the client should actually be using? And how do you remain consistent when you have different prices for the same assets on different exchanges? So whether you're accounting under IFRS, US GAAP, you need to identify the principal market, which is the market having the greatest volume and activity. What are some of the good practices when it comes to valuation? And would you have specific examples of where you've audited certain companies and you've seen certain wrongdoings in how clients were valuing these assets?
Mm-hmm. Yeah, if I may take this one.
Yes.
Yeah, regarding the cutoff of the rate, of course we should assume that the transactions and the exchange that is used has a sufficient volumes of exchange to get a good rate. In theory, as there is no regulation regarding this rate, the company should take the thinnest rate as possible. That's the theory. Some of our clients can go to a 5-minute rate and can account their transactions with the thinnest rate as possible. But the most important part is the disclosures on the financial statements and the information that is given to understand what was the way to evaluate these assets.
What do you mean by the thinnest rate, you said?
the time range of the a 5-minute rate, 5-minute range of the rates. Some of our clients use a daily rate because they use to make as there is a closing rate. But as there's no regulation in France regarding the accounting of cryptocurrencies, clients need, and in theory, to get the finesse rates of the transactions. Yeah. But it all depends on the materiality, of course. That's the number one thing to see for audits. It's regarding the materiality and the volume and the volatility of the assets also, and we need to document that the volatility of the rate doesn't impact the valuation of the assets in the financial statements.
Absolutely. I think just to add that a lot of that's been covered. However, for us, often it's ensuring consistency. It's ensuring consistency both throughout the year and throughout the period, and also year on year. The crypto industry moves so quickly that often there's new pricing sources available 1 year to the next. It's assessing what is the best, and should you just be staying consistent 1 year to the other. Again, also there's a lot of different pricing sources that can be used in exactly the same way as there are for traditional financial assets. That's absolutely fine. Often it's looking at them, comparing them, looking at the market volumes, how active that market is, and again, then repricing those assets often at year end to ensure that what the pricing methodology used does correlate correctly to an active market. As long as that's the case and things are consistent, then we are normally okay. When you look at the range of pricing sources and the range of prices that those sources provide, often you find that the differences are highly immaterial, and therefore it's coming up with an accounting policy and sticking with it.
Would you have any recommendation for a pricing source that does provide with historical prices in general?
So getting historical pricing isn't necessarily the issue. Where we have more of an issue tends to be on the slightly more unique digital assets that one might hold on a balance sheet. And that's where you need to look at different, go and try and find different pricing sources that do have sufficient activity to come up with a reliable pricing source. And one of a classic example of that is with NFTs. You've got they're not a homogeneous good that you're able to go and find a pricing source of market activity that's going on right at your year end, and it's therefore coming up with that valuation methodology, and as I said, sticking with it, keeping it consistent year on year. As long as that's the case, then there's normally no issue. So it does depend asset by asset.
All right.
And it also depends on the exchange used by the company. If the company use a very low volume exchange, they will need to get another source to get the perfect price of the market. And most of the time, our clients use a major exchange as Binance. So there's no issue regarding the quality of the rates used. And as James said, it's not so difficult to get an extraction of the rates. One of the most important thing for us is if the company have a lot of volumes of transactions, it's important to get an automatization of the valuation process. Most of the time, we can see that our client are making manual downloads of the data and reconciliation on Excel file and so on. And so it's opening many operating issues. So the best thing to do is to get an automatization through a crypto accounting tool or through data sources such as Keiko, for instance.
And just to add, that you've got regulated exchanges. Using an exchange that is regulated versus unregulated massively changes the reliance that one can place on both the volumes and the data that's coming off that exchange. So focusing on the good exchanges, the exchanges that are well managed, etc., massively help.
Moving on to the other topic, the last topic of the day is on completeness of on-chain transactions. So one of the main challenges with the aggregating data from block explorers is to ensure their accuracy and consistency. Now, I want to ask you if auditors should be running, should auditors be running their own nodes and indexing the data themselves instead of relying on third-party providers like Etherscan? This is like my first question, and then I'll ask you the second question about, it's over there, but are there additional data reconciliation exercises that you guys would usually do?
Mm-hmm.
So for us, I would kind of switch around these questions. For us, the number one thing to do is to check the integrity of the data. Where that data is necessarily coming from, we tend to mind less about. Why is that the case? Is because you either have good data or you have bad data. If it's good data, I don't mind where it's coming from. What I need to be able to do, though, is find a way to assert whether that is good data or bad data. And that's where the likes of running your own nodes, etc., helps you determine and make that judgment call of good data to bad data. We do write our own nodes in-house. Why do we do that? That enables us to collaborate the data that might be coming from a crypto accounting software, might be coming from the likes of a block explorer like Etherscan, etc. That then enables us to say, okay, well, the data that is going into there is collaborated with the data that we are seeing directly from on-chain activity by looking at the nodes. And if the two are matching up, then often we're happy to use that data and proceed with our audit. So actually the completeness of the data there is the very first thing we do. It's the most important thing, because if you don't have that right, then everything else you do might be brilliant work, but it's not necessarily going to be correct.
Yeah, we have the same approach at PWC. We run our own nodes to be sure that we know the source of the data, and we know that the data will be complete and accurate. But of course, if there's a third party used by our client, and that this third party can give us all the requirements such as SOC reports, and we need to go back to the first questions regarding the SOC report. But if we can rely on the data of the third party and we will test it through our own tool, it can be also a good alternative. Yeah.
Now, how about if the company is using a crypto subledger accounting solution, the likes of Crypto, Bitwave, Trust Finance, all these emerging companies now who can furnish you guys with SOC reports. Now, in terms of testing for that client's data, that would mean you would have to spend less time, and actually probably for the client, it's also less audit fees. that they would have to pay in return?
Yes, of course. It's if we can conduct all our diligences to be sure that we get the integrity of the data through SOC report, through our own tests, it will allow us to get an easiest way to audit the data, so it can make the audit smoother. Yeah.
Yeah, and
Right.
look, it's often when you're looking at SOC reports, what is slightly less common to happen is for that SOC report to cover the scope of every single data feed that crypto SaaS product is using and obtaining. And that's where often, as I say, it's the scope of those reports, because you can have a really good SaaS product that is working really well, but again, it's the data that's going in there, and if it does cover off the integrity of that data that's feeding the product, then brilliant. But often that's not the case, and therefore it's both looking externally whether we think the data is correct, but also working with that provider, whether it be Crypto or Bitwave or Trez, etc. There's lots out there, and they're all doing very good jobs. And working with them to understand how they're obtaining their information, what they're doing with it, and then what's the output of it. And that's where us having a really close working relationship with all of these software providers is really helping both us from an audit perspective, and also those software providers understand what the needs are of auditors. And it's that close working relationship that helps with that.
And if I may add, it's also important to ensure that the SOC report cover all the period of the financial statements, because most of the time we can see SOC reports covering only few months of the period. So we will have to make some additional work if there's a material transaction made out of the period of the SOC report. So it's really important to get a complete period of testing in the SOC report.
Perfect. We're already coming to the end of the webinar. We're slightly ahead of schedule. So I'll ask everyone for the Q&A. Feel free to drop your questions in the chat bar. If you want to be on stage, I can also invite you on stage. In the meantime, while people drop down their questions, has there been anything that we didn't cover today during the webinar that you think would be important to mention to the CFO, CEOs preparing their financials that come to audit? They have to be ready for this.
If I may, we talked about it, but I think one of the most important things, and James talked about it, it's the internal control. As a blockchain decentralized the data, it's really important to get a strong internal control to ensure the property of the assets and the integrity of the data that is used and so on. And most of the time we can see pure players that are only fintechs with few employees, and the internal controls come after the development of the business. And it's really important, if you want to get a good auditor and a good audit, to get an internal control implemented at the very beginning of the company, because it will change everything for the audits.
Can you give us one or two examples?
Yeah. For example, regarding if a company uses self-custody solutions, they will need to document properly the generation of the key. As example, the key ceremonies that we are asking at PWC. So the documentation of the generation, they will need also to get a matrix risk of all the risk they identified and all the controls. So that's a strong work for small companies, but it's really important to get an overview, a global overview of the crypto risks and the controls implemented to cover this risks.
For me, I think the most important thing here is to be ensuring that you're working with the right partners. You need people that are crypto native and people that understand what is going on within the crypto industry and the best practices. That both comes from internal controls, the processes, and then as well as how to actually conduct that audit. You know, there are very few players in the UK and worldwide that actually understand the crypto industry. And you know, here at Harris&Trotter, having a designated team, that's all we're doing. That's all the team is doing. And therefore, the growth rate of learning, of understanding of that crypto native knowledge is absolutely huge. And it's applying that both back to the basics of audit and on the flip side, applying from really good audit practices back to the crypto industry. So it's working with the right people, putting the right people in place to develop those processes and ensuring that you follow through with those processes. And as I said, ensuring that you've got an auditor there that actually understands your business, because so often it's possible to work with partners who don't understand what's going on and don't necessarily have those expertise, and you can't blame them. And therefore, you need people that are able to learn and learn quickly. And at Harris&Trotter, that is something we've been able to do and something we're proud of, and we feel adds the biggest value to our clients.
We have one question from Guillaume. And this question is for Aymeric. So if I understood correctly, you were saying there's no regulations in France for valuing crypto assets. Does that mean you consider the provisions of the Plan Comptable Général, especially section 619, which aren't efficient and sufficient to properly value crypto assets?
No. Of course, valuation regarding the Plan Comptable Général is totally applicable. We need it's just the way and the source of the rates that need to be taken that are not always precise. And in the Plan Comptable Général, in the French GAAP, it's not precise the rates that need to be used. And as the cryptocurrencies, there's no cutoff of the rate. There's no end of the day. It can be judgmental to choose the good hour of valuation, the good date, and so on. So it's really important to get the thinnest information as possible. But regarding the valuation, it's always as always. You need to depreciate your assets at the end of the year regarding the best information provided.
I'm not seeing any more questions coming. Because we have a few minutes left, maybe I'll ask you another question, which is on how do you actually, so I've been an external auditor before, but now how do you actually attract talent with the right knowledge of like how does crypto work? I mean, how are you currently recruiting people to work on external audit engagements?
I think I can jump in there. So the simple answer is there almost does not exist anybody in the world that is both crypto native and also a qualified accountant. The two don't really exist in terms of people out there, which is absolutely fine. what we have done is we have recruited the very best of auditors, of qualified accountants who are really, really very, very good accountants and very good auditors, but have a passion for crypto in some form or another. Put the two skills together is how we've managed to develop an incredibly strong team of crypto auditors, of people who understand digital assets and understand the accounting side of things. You need to be able to have both and develop the two over time. As our team grows, we've really been able to capitalize on those skills and train between each other to take the skill set of each person to have a whole team that are strong crypto auditors.
Yeah, totally agree. And I think we have from PWC side, we also have both a content specialist and a crypto specialist. But I think from a personal view that it's easier to get a good content that is then trained to crypto than the other side.
We have a question from Peter. Peter is asking, what challenges have you or your clients encountered when trying to evidence historical positions applied to liquidity pools and accrued rewards?
Yes, that's always a big topic. Yeah. James, go on.
Yeah, this is an area which is complicated and happens, the market moves so quickly in terms of products available and out there. If, a few years ago, liquidity pools weren't a thing. They didn't exist. Today it's part of everyday business and terminology. So it moves quickly, and as a result, the availability of historical data becomes a problem. We've looked to overcome that primarily through technology-based solutions, where we have gone away, written nodes that are required and written pieces of data that allow us and the code to get that data, come up with what a position might have been at any given time, and then go away and try and recalculate it. So it's an area that's challenging, but an area that we're also able to assist our clients with.
Perfect. If we don't have any further questions, we have a few minutes left. If anyone has a last question. If if no one has any questions, thanks for joining the webinar today. I'm going to share the link of the event that we are hosting during ETHCC in Paris, which will be held on the 17th July. It's going to be a brunch event from 9 to 12. So it's going to be the first day of the conference in Paris. So before heading to the conference, please come and say hi, and it would be great to meet up with you. Do feel free to let me know what the topic of the next webinar. I'm always listening to you guys to organize these webinars. All right, so thanks everyone for
thank
joining.
You for having me.
Thanks, Jim, and thanks, Aymeric, and thanks to everyone.
Thank you.
Bye-bye.
Hopefully we'll meet soon in Paris.
With pleasure.
Cool.
See you soon.
Bye.
Bye.